Good morning, y'all. Back at it with another amazing week ahead. Good morning, Eddie. Yeah, so today we're going to go over some important things, as always, right? We're going to talk about some keys to consistency, keys to process, obviously a weekly overview of what could be expected for the coming week. And yeah, just take some inventory for many aspects as far as process is concerned. If you guys could let me know in the chat if you can hear me okay, that'd be great. Let me fix that real quick. All right. Yeah, let me know in the chat if y'all can hear me okay. Yeah? All right, cool. Perfect. What's up, Zach? Been a while. Happy to see you here, brother. All right, cool. So yeah, as always, right, we're going to start here. We see this in FOMC related situation coming out on Wednesday. There's no news on Tuesday. Sunday we don't trade at all. We just get intel and we do these weekly calls, right? Unemployment claims is on Thursday. That is my favorite news event because it presents volatility, but it doesn't present too much. But then sometimes it doesn't really do anything, right? But that's the nature of things. But yeah, for the most part, I love when unemployment claims come out because it has just enough, right? It's one of the most consistent news events that I've been able to find opportunities around in the last 5 years. So yeah, definitely worth the study for yourself. So yeah, going into the week, every week, just a reminder, we always think of power 3 right away. And the economic calendar, in many cases, will act as a macro, similar to the lower time frames, how there's specific time elements that promote price moving. It's the same with the economic calendar, but the economic calendar can be looked at as macros for the higher time frame delivery. Because for a move to take place on that higher time frame, we need to see institutional sponsorship. All right, so whether it's trading to a particular PD array or target, liquidity, whatever the case may be, or if it's moving away from that and we're anticipating a move away. Both of those scenarios, if you study this, right, both of those scenarios generally take place during one of these news events, or better said, it's used as times where price is going to most likely make the move. And then you think of power 3 on top of that. Tuesday and Wednesday are generally the expansion days within the weekly range. Okay, so with that being said, you could hopefully see why this is so important. And then of course your own studies are going to provide evidence to this as well. So yeah, you want to keep that stuff in mind. These are some little elements that we have to layer on top of our perspective as traders. I'm a daily range, weekly range framework type of trader. I like to scalp. I like to day trade. I don't really do much long-term trading, but at the same time, if I wanted to, I could very easily do that because I'm rooted on the higher time frame. So if you get comfortable with that higher time frame, you put yourself in a lot better position to be in line with a larger, longer term direction. And bias and narrative, like I've been talking about the last couple of weeks, are different. For the most part, bias can change on a day-to-day basis. Narrative, if you're rooting it on the higher time frame, generally does not. It takes a lot to change the overall direction. Okay, so yeah, you wanna make sure you keep that stuff in mind. All right. So yeah, with that being said, obviously, Tuesday, there's no news, so expect potentially high resistance. And then, Wednesday, right, given the fact that there's one of the highly volatile news events, that being the federal fund rate, this is going to be very, very impactful. It's midway through the month already. We are in the 16th, right? So March 16th. Generally, that is when quarters change. So we'll see what happens in terms of the quarter adjustment. And the way that you gauge which quarter we're in, right, or what contract month you should be trading in, is you go to bar chart and you see which of these contract months have the higher open interest, right? So you could see how we're still not done yet with the current quarter that we're in. All right, if we switch to the S&P, let's go see what that looks like. So you could see interest is already starting to adjust to the June contract. Okay, you see that numbers are picking up here. So once this number outmatches this number, this contract month becomes obsolete. And the more volume is going to be inside the June contract for this, in this case. Okay. So every time you shift quarters, right, or change the contract month going into a new quarter, this is how you want to gauge that if you're a futures trader. And of course, if you're even a Forex trader, or any other type of trader, it's good to know when the quarters are going to change, because there's rules around that. The week before, the week of, and the week after a quarterly adjustment or a transition from one quarter to the next, many times it's going to present you with harder to trade environments. So again, it's just another one of those things to add to your list of knowing when to trade, when not to trade, and how to trade in certain scenarios, and what you should be anticipating, so that when times do come, if you take a loss or something, and this is something like this is present, or a red folder news event's present, or a holiday's present, you can start to observe how you need to behave. Start to gauge what your risk protocol should be. Should you dial it back, or should you just act in a normal way? Okay. Some of the boring stuff, obviously, but it is what it is, right? So considering that we're still in this contract month, we don't really have anything to do because open interest is still higher in the current one. So we will keep that in mind, but now we'll start to move on to some of the different assets. Make sure I got everything. So we'll start here as always. Let's go start with the yields first. Okay, so we could see how price came off the low here. There's SMT at the lows, right? Slow was taken out here. Slow was taken out here. And now, since that external range liquidity has been taken, price is now starting to retrace. This is why when price takes out higher time frame levels like this, you shouldn't be running in like everybody else thinking the price is going to continue to fall in this case. Once it sweeps that, you should automatically kick yourself into, okay, where's the retracement going to reach to? And if it doesn't present the retracement, that's telling you something. All right, say it just starts, it did this and then all of a sudden just starts dumping off. Then clearly we're in a heavy environment, and, we'll have to see more evidence of possible retracement. When price takes things like this, it's reasonable to anticipate some kind of pullback. We see there's SMT at the highs here too, along with the SMT at the lows. So again, these are interest rate markets. So what news event is coming this week? Federal fund rate adjustment. So apparently the forecast is going to stay the same, which I wouldn't doubt. They might even raise the rate. It's part of the way that they combat inflation is by increasing the rates and all that. So we'll keep that in mind. Again, we have retraced. There is SMT, some starting points we obviously do every week. Previous week's high, previous week's low. Okay, those are the near-term liquidity pools that we're going to identify. Whether price drops or goes higher, when the new candle forms, it's going to have to violate that if it's going to go in either direction. We do have and then once we take that information down and we know that, we now look for near-term buy-side arrays and then sell-side arrays, right, or POIs. Okay, so weekly high, weekly low, first step. Okay, second step is where are the PD arrays? Okay, so there's a fair value gap in here. There's a pretty decent sized wick in here that price has respected for the most part. There's SMT at the highs, like I mentioned, but there's also SMT at the lows, right, ahead of the federal fund rate adjustment. So if price stays below this fair value gap and it continues to show respect to the midpoint of this, we also have an inversion fair value gap here too, if it wants to continue to hold. So nothing changes until we see something change. Okay, so if price gets back above this fair value gap here, I know it's a little bit busy, but hopefully it's not too busy. But yeah, so if it stays above this weekly fair value gap, if it violates the midpoint of this center portion of this down wick, and we get back above this weekly inversion fair value gap, that turns my attention to buy-side liquidity. All right, we have this retracement, we have SMT, so obviously we got to continue to wait and see. This is our most recent swing high to most recent swing low. Sell side's been taken, right? It purged out buy side in some capacity, responded to this order block and dropped. So this high to that low is our current weekly dealing range. That's how we identify equilibrium. Okay, so you see that we're stalled out at equilibrium. If you guys have been here for a while, you know that when price is at a higher time frame equilibrium point and it's just staying right next to that, that could generally leave us in a condition where price is harder to read. It could put you in consolidation. I don't know why that is, but that's just something that ICT has taught, and I mean it proves itself pretty regularly. Equilibrium, when price is stalling out around that, especially on the higher time frame, can promote consolidative markets. And then if the interest rate markets, the bonds and yields, are consolidating and not really doing much, generally that will send reverberations through other markets and promote them to also consolidate, because the heartbeat of the market, at least in this case, and I'm sure it's the same for a majority of other countries' markets as well, the interest rate markets are the heartbeat to what other markets are going to do in the overall grand scheme of things. That's why we start here. That's why we spend so much time here. All right, so if we see these consolidating and not really interested in one direction or another, we got to consider that alongside some of the other things like the news events that are ahead of us. Like we started the call off with, the adjustments in quarters. We're going from one quarter to the next. So, because that's the case, we want to make sure we are lightly engaging our risk. Again, it's never something to be fearful of when I mention these types of things. It's just getting a feel for the overall conditions, right? And how you should view your risk. Because if we're just in there gunslinging like every day is a trading day, like a high probability trading day, you'll notice from experience, which I'm sure all of us have experienced, not every day is a good trading day, even if you're a scalper. Okay, doesn't mean you can't trade on those days and find opportunities. It just means you have to gauge your risk properly. Otherwise, you're just going to get eaten up, and you're going to have to deal with unnecessary large downsides, which we want to learn how to avoid. And this information is somewhat part of that process, right? Or it's heavily part of the process in identifying whether something's worthwhile to engage at normal risk or dial it back. But regardless of the conditions, if you want to listen to the things that I try to share with everybody in terms of risk management, we never go over 1 to 2 trades a day. And if we take a loss, we drop it by half. If we take 3 losses in a week, we're done. Or 3 consecutive days of losses after we've also cut our risk, we're done for the week. It's very easily said, but 95% of people will not will not listen to that information. And that it's part of the statistics as far as why certain people can succeed versus others, or why it takes longer for some and shorter time for others, So you want to keep that in mind. So given what we just talked about here, keeping in mind what price has done, another question you want to ask is where price came from. What did last week do and the prior week? The overall delivery, what has price done? Right? We've been on top of this retracement. From up here, we anticipated these fair value gaps potentially being attacked. Right? We saw that this failed, so it left an SMT, and so now we got to figure out what it's going to do. We got to observe what it's going to do in these areas. If it respects the daily fair value gap here, it could run up and take away the SMT factor that's at the highs. But if it was to respect this and start raging lower, what do you think our objectives are going to continue to be? Unless something changes, it's going to be bearishness for this market. The information and analysis tactics we're using here are justified on every market. Okay, of course we're going to go over other markets, but just because this may be a market that you don't trade, I don't trade the interest rate markets. Just because you don't trade them doesn't mean that the analysis you do here can't be applicable in terms of strategy and approach to other markets. It's the same thing that we do. We look for the same things, same liquidity pools, and do the same observations in terms of the overall conditions. Is it going to be high probability or not? Right? Is it at equilibrium? Right? Is price stalling out? Right? It's all the same concepts. What we can see also, as far as where price has come from, we see this wick here. It has respected and couldn't even get down to the midpoint of that wick. Okay, we see that the other two kind of dug a little bit deeper, obviously. So that's something we want to keep in mind as well. See if that continues. And then, of course, if it gets above, off the heels of that, if price gets above the weekly fair value gap here, this weekly fair value gap as well, and then violates the midpoint of this wick here, again, those are our signatures above price that would promote the fact that this SMT is in fact going to continue to push price higher. And then, of course, in that case, our mindset goes to wanting to see this go higher. Okay, and then if that is the case, that delivery, right, if it's going to go higher for the yields, that will indicate possible bullishness in the DXY, right, or it will support bullishness in the DXY. As you guys have seen, if you spent any time with us this year, the overall interest rate market relationships versus the other assets has been a little bit cracked, And of course, that has to do with all the different things that are going on in the U.S. economy and just, things overall economically. All right, they will get back in line, which will promote continued trending environments. When things are in sync, doing what they're supposed to do or what they're anticipated to do overall in terms of risk on and risk off behavior, that's when you're in a healthy trending environment. Okay, so just another little side note there. As far as the importance of this market. So yeah, that's what we will observe. Let's just drop down to the daily real quick. We have an order block here. If price was to get above that, of course, that would fall in line with some of the other things we were just talking about. And then, of course, if it was to get up above here, overall, more long-term view would be to aim for more buy-side targets. Okay, and you could kind of see where those are at. Simply look for the highs and look for PD arrays above price, right? And then the same thing is true if it wants to go lower, right? If it was to drop lower and stay below these areas I just mentioned, then obviously our attention goes to this previous week's low, this previous week's low, and then any other PD arrays that we potentially can see. We got a fair value gap down here. We go to the weekly chart. Let's see. We did fill in the rest of this fair value gap. So I'd if we're going to continue to see price drop, and this is going to be a retracement, of course, these areas down here should not have any impact. It should be able to slide on through it. Once it hits these areas, though, you can also use those opposing PD arrays to this downtrend. Any of these discount arrays, if price hits a higher time frame discount array in a downtrend, that can be a point in time where you can anticipate possible retracements or counter trend ideas, right? So yeah, like this, for example, was running lower. It hit a discount array and then it turned around, right, and started to retrace. So going into this next week, we're going to gauge and continue to monitor whether this is going to hold and continue to push lower. But if it does choose to impulse higher and violate these areas, we also have this down candle that could turn into a bullish order block once price breaks through that, because that will be evidence of a change in the state of delivery with SMT at the lows, right? So you can start to layer things on top of why price going higher if it was to violate these areas. You can put the why description behind the buy side delivery. But of course, unless that happens, unless things further confirm that, we're still in a move that's going lower. So, we'll see if that's going to continue or not going into the new week. All right. And then, of course, whatever this market does, that's going to have a pretty dramatic impact on the DXY. And if it stays in consolidation as well, that's also going to be impactful across the markets, right? In terms of like the indices and DXY. All right, so I hope that makes sense. Let me know in the chat if you have any questions. But with that being said, let's move on to the bonds now. Take some of this stuff off. So again, we're going to do a very similar thing. We're going to look at the previous week's high, previous week's low. Those are our near-term liquidity pools. Let's see, do I have them marked? Yeah, so weekly high, weekly low. All right, we could see where prices come from. Okay, so prices came from the high up there, right? There's SMT similar to the other market, but it's in the opposing view because this is a reverse correlated asset to the yield market, right? The yield market impacts the DXY. The bond market, T-bonds or T-notes, whatever you want to call it, generally directly impact the foreign currencies in a positive manner, as well as the indices, right? So if you confirm an idea for, say, bullish indices, okay, if you're going to confirm that, back-end information is going to be this market going higher, the yields going lower, and then, of course, that would have to also be complemented by bearish DXY as well. So that is a very simple way to gauge whether you're in a healthy trending environment, is whether all that stuff is in play and following the symmetrical nature and delivery that those markets present. Okay. And if everything's cracked in correlation, again, it's just that's a high resistance, low probability condition. Doesn't mean you can't find opportunities, right? You could always trade those times. But again, the importance of being able to identify the current condition is, it's important because you'll be able to gauge your risk properly. Because if you're just pushing 1% every day, not caring about these types of things, you're going to take losses. And if you don't have experience and understanding with, these types of things, it's a little bit harder to deal with the losing streak, because then you're just wondering, is it my model? Is it this? Is it that? When in reality, it's, could just be a situation where the market's in a little bit more difficult condition, so you can narrow your focus to what is really the problem versus thinking you have to scrap everything because you made some type of mistake or got wicked out or, whatever the case may be. Generally when traders feel that they have a good process, but they're still unable to be profitable, generally it's small adjustments that'll lead to large changes, especially if you have more than 3 years experience and you're still struggling. All right. So yeah. So looking at price, like I mentioned, there's SMT at the highs Maybe we can also move to the monthly time frame too and just get a feel for what that looks like. Okay, so you can see we're in a large range-bound environment. We have relative equal lows down here. That's pretty significant. We see that there's a run on the highs here. Okay, so that high was taken and price ended up dropping. We got SMT also here on the monthly chart. But again, we can just automatically see that price is in a very back and forth environment. It's been that way for a while on these higher time frames. Interest rates over the last like 2-3 years, I mean, they've been insane. They were at 8% at one point, and then now they're thankfully going lower. But they cut rates too intensely last year when they were trying to supposedly fight inflation. So that has given America stagflation, so it's crazy what's been going on. And we could just see how insane it's been. But yeah, so, from this monthly chart, again, just like we were on the weekly chart, how we identified the weekly highs and lows, the previous and most near-term weekly highs and lows, we can also do the same thing here for the monthly, right? This is a monthly low, monthly high. Regardless of where it goes on this time frame, whether it's going to be bearish or bullish, before we worry about any of these areas over here, right, we have to also just consider the monthly high and low, because that is another near-term liquidity pool. This range from the month here that we see, that's our current trading range from the overall perspective. And if price is going to attack the low or the high or the fair value gap or anything around it, before it gets there, because most of us are day traders and scalpers, and maybe some short-term traders here and there that hold trades for a day or so, before it gets up to these levels, right? Identifying these levels allows for us to have near-term framework, so you're not scattered all over the chart. So again, we're just narrowing the focus as we identify the most important liquidity pools and points of interest. PD array wise, you want to look above price, find the closest near-term PD arrays above and below. And then obviously as we drop down in time frames, we start to identify the important liquidity pools. I have a PDF, a weekly daily bias checklist. So if you guys haven't downloaded that, it has like a lot of the things that we talk about here, which you can obviously use to follow along. It's could be helpful to you if you're open to having something like that. You just go into the description of the video, and it's the weekly daily bias checklist, and get your hands on that as a little reference. But yeah, so once we get the monthly high and low, once we drop down to the weekly, we get the weekly high and low, identify the most near-term liquidity pools. We can see how price, again, has pushed off the high, left SMT at these highs. We have relative equal lows down here, right? But we do obviously have SMT that led to price retracing here. Okay, good morning, Tony. Happy to see you here, brother. So we came up off this retracement, we purged out this high, and now price is doing what? It took out the buy side liquidity, so now what is it doing? It took out external liquidity, and now it's seeking for internal. Okay? So yeah, we're going to have to see. In order for us to believe that this is going to continue to drop overall, right, in like in a meaningful way, and maybe start targeting sell side liquidity, I personally would want to see this fair value gap here turn to an inversion and then give us a strong drop. We have an inversion for fair value gap here. If we drag that over, we have this fair value gap here. So, also off the heels of a run on stops and an SMT. So similar to the view here, right, off the SMT of this low, in the buy side areas that would prevent this from going lower. Similar to that perspective, we have the opposing view, right? We have a fair value gap here, all right? We have a fair value gap here. We have an inversion of fair value gap. And we have an up wick and a midpoint of that. So if price was to smash through those three areas, remember 3 PD arrays above or below, if we're trying to validate a trend overall, we shouldn't see 3 PD arrays on the current time frame we're doing this analysis on get violated if we're going to support a particular run. Let's just assume that this is going to go higher, right? If that's the case, then we should see responsiveness from this area, right? If it does go higher, right? Again, we'd like to see this hold, and if that was to hold, we could see there's a run on stops here. This could maybe act as a shift in market structure, and this could be a fair value gap using the YouTube model from 2022, just on this weekly time frame, to help build a framework alongside the other analysis concepts we're using to identify which direction price is going to go. So if this was going to hold, right, and it runs below, it takes out these equal lows because there's equal lows here, and then it starts to rampage higher as a response off this fair value gap, then again, our assumption that price is going to go higher remains strong if that's going to be the case. But again, if price was to violate these three areas, this fair value gap, the midpoint of this wick, and this inversion fair value gap, I mean, you can make the argument that there's a volume imbalance in here too, one over here, right? So if none of that holds price higher and it just starts smashing lower through those, what is the justification for us to want to push buys aggressively? There is none. It's just forcing your will at that point. And of course, that doesn't do anything. It just puts you in a bad position for the most part. And it disables your ability to adjust. Okay? By the way, if you guys get value from the content, definitely like the video, share with your friends, and don't forget to subscribe. That's greatly appreciated. Your support is definitely appreciated. But yeah, if you could do that for me, that would be great. Again, if you guys have any questions, obviously, along the way, just let me know. And we could pause and attack whatever questions you have. All right? But yeah, with that stuff being said, if we look at price here, let me see, can I fix, yeah. So those are my levels, my line in the sand areas. Okay, we have a fair value gap in here. We do have SMT at this fair value gap level, similar to what we have at the highs up here, right? So there's SMT there with the fair value gap here, because the 30-year bond market here, it's basically tapped into it. So we'll see what the response is going to be from there. It's the same thing, though, here as well when it comes to the invalidation levels for us to, start to think price is going to continue to go lower and support this SMT at the highs. It's going to have to violate the fair value gap. It's going to have to stay below this this inversion fair value gap or reclaimed bearish fair value gap. We also have a volume imbalance. These are also new week opening gaps for the most part. This is a good observation too. Most people don't know. If you go into the volume imbalances you see on the higher time frames, most of the time, or a lot of the time, I should say, those are new week opening gaps for the most part. It's not always, but for the most part, you can take that observation and go look at it and see that that's a layering effect with the new week opening gap theory. When you look at the higher time frame, generally the gaps in price a lot of times lead you to new week opening gaps. All right, but yeah, so if we violate those levels, if it can't stay above the midpoint, notice how I used the midpoint almost perfectly here in conjunction with the fair value gap off this retracement. Notice how price behaved with this wick too, right? It could not get to the midpoint of that, and at the same time there was an SMT. I mean, that is very convincing that a retracement was going to take place in some capacity, given the fact that we see that, okay? And now that it did retrace, now that it did leave SMT here, and there's a possibility for price to want to continue going higher off this. We have a shift above this high, right? So all these different factors being considered, again, we have to see what takes place here in this fair value gap. If it holds and starts to rampage higher, then you could start to make an argument based on these areas being respected, that price may look to continue going higher. And again, before any of that stuff above is going to be attacked or anything below is going to be attacked, whichever direction it goes, it's going to have to deliver through this high of the week from last week or this low of the week from last week. Okay, remember there's going to be one candle that forms for the next week here. So we need to observe where that candle is going to go. If we can identify that, and then of course layer different things that we talk about here on a weekly basis to confirm or negate an idea, If we can identify where that weekly chart's going to go, we're going to be able to be in line with the overall narrative. Okay, so it doesn't have to be overly complicated, right? And I hope your guys' time here has provided evidence to that. But yeah, one little side note I want to mention too. I've been getting a lot of messages the last week of people having issues with over trading and over leveraging. Okay, what you need to realize is every time you do that, you're pushing your success further and further away, and you're building bad habits. There is not any time in the market where over trading or over leveraging is acceptable. I don't care what you think. I don't care what you feel. I don't care who told you this or that, or maybe some influencer was over trading and over leveraging and they did well. That's not you. Their performance is not going to be your performance. They may have more experience. They may be able to break their rules from time to time, and there's back-end knowledge that they have that made them have conviction in whatever opportunity they chose to overtrade and over leverage in. Until you're profitable, you don't want to mess with these things. Even when you're profitable, you should never overtrade. Because what is the purpose? What does overtrading and over leveraging come from? Right? Just think about it. What does it come from? Your inability, or shouldn't say your, right? Our inability to accept a loss, our inability to be comfortable with that uncomfortable feeling, a lack of trust in our objectives or how we operate as a trader, okay? Or unreasonable expectations, or we're just in a rush, lacking patience, right? And yeah, like Tony just said, impulsive behavior and thoughts. We all are human, okay? So it's going to happen. But again, it will never be a solution to any problem you have to overtrade and over leverage. Maybe you'll get lucky a couple times and overtrade and get out of drawdown. You don't have to do that, right? If you're going to trade for a long period of time and you want to be successful, the last thing you want to do is overtrade and over leverage. Because if that becomes a habit and you convince yourself that, I did it a couple of times and it was profitable, so I'm going to just do it every time I get into a loss, or every so often I'll overtrade and over leverage because it works sometimes. If you do that type of stuff and you build that habit, once you do get to where you're trying to go, maybe you pass funded accounts, maybe you're on your way to almost getting a payout, or maybe you just, you have a personal account and you're trying to hit certain milestones. If you carry over trading and over leveraging into that aspect of things, one day is going to blow you out. And guess what that's going to do? That's going to make you regret. That's going to make you have the what ICT calls the beaten dog syndrome, okay? Where you're going to hesitate, right? And it's just never going to be an answer to anything. I don't care what anyone says. And if anyone justifies that with themselves, that's going to be their own issue. But if you're going to take my advice and you're here to hear what I have to say about things, how I've been able to do what I've done in the last 5 years, and how I've been able to help traders, there's a commonality between the traders that do well that come to me, or the ones that learn ICT. There's a commonality between them, like their successes, right? And it's always the fact that they follow the rules, because the rules are there for a reason. Okay, why don't we want to overtrade or over leverage? Because for one, we're trying to save our capital. Two, the reality is we're going to get things wrong at times. Okay, it's just unavoidable that we will have those times in our trading where things just won't work out right. We'll take a loss. All of our rules will be there, and then something happens and price goes against us or takes us out early, and then price goes in our direction. Okay, things like that are going to happen all the time. Okay, and carrying over trading and over leveraging into your success, or falsely attributing over trading and over leveraging to you making something back or something, I'm telling you, it's a sabotage trap. And if you ask any trader that is worth listening to, that provides proof that they know how to do it, whether that's them showing accounts or trading live in front of people, none of them overtrade. And if they do, they probably have a strategy behind that aspect of things. But overall, each trader is their own person, obviously, and you can do whatever the hell you want. But for the most part, it's not professional to be. Think about it. If someone was managing your money, okay, if you gave them the money that you're trading with, and you're like, yeah, you're a good trader, whatever. Here, I'm going to give you the money to manage. And you look at their performance and they're over trading and over leveraging, wouldn't you be worried? I mean, we've seen the results of over trading and over leveraging. It's not good. Even if there's some times where it helps out, long term, it doesn't work. So if you had someone that was managing your money, that you gave them your money, would you trust them if they're over trading and over leveraging? Would you trust yourself if you're over trading and over leveraging and it's still an issue? Would you trust yourself with your money if you were gonna, give yourself the money to trade with? It's too dangerous. The more trades you take, say you took 2 losses in a row, you're now automatically, I don't care who you are, you're in a state of heightened concern. Okay? Because we don't like that feeling. So, but if you go and overtrade and try to do more, you're now in the mindset that you don't want to be trading from. And that's how your rules and stuff get tossed out the window. So you got to be extremely cautious of this because our mind plays tricks on us. And the algorithm in the market knows that. That's why it does what it does. It knows human nature. And it's just going to get sharper and sharper and sharper because of AI and all these different things. Things are going to be more clean. It's going to get a lot more dynamic. Okay? And it knows it's human nature. That's why it does what it does. So you cannot allow yourself to let a day that could have been a paper cut turn into a blown account. Every time you do that, again, you're building bad habits and you're pushing your goals and dreams and aspirations farther and farther away. I don't care who tells you different. The best traders out there, if you listen to, a handful of some of the people that seem like they're really good and prove it, I mean, they all say the same thing. There's a reason that they say the same thing. No over trading and over leveraging. Once I removed that from my trading, everything became less stressful. The losses I would take, I'd be able to come back in the next day with a clear head, not regretting my decision over and over and over. Again, when you do an action that produces regret, you're damaging your self-confidence and inner trust you have within yourself and your model. So over trading and over leveraging damages traders because of many, many impacts that it has. Okay? Like it doesn't just damage your account financially, which it does, but it's also attacking your confidence. It's attacking your ability to believe in yourself. It's making your goals go farther and farther away because now you got to get out of more and more drawdown. If you're following what I say and what ICT has pioneered in terms of regressive risk control, meaning when you take a loss, you drop your risk by half so you can have a smooth equity curve. Doing that aspect of things, like dropping your risk, yeah, it'll take longer, right? Sometimes, that's an argument a lot of people say. Oh, I don't want to do that. It's going to take longer. But over trading will have the same impact, except one, you'll be able to manage it easier, that being the regressive risk control, versus the other one where you're coming now into the market more emotionally charged, probably for weeks on end. And then, of course, you got to regret it, and you'll think about it years from now. If you follow the rules, your equity curve will look a lot better, okay? And your mindset will be a lot more calm, controlled, and you won't have as much emotionally charged battles to go through. And long term, it's the best idea. Because again, like I said before, the last thing you want to do is go into, you don't want to hit your goals and get to where you're trying to go just for you to overtrade and over leverage. And, maybe you had a good couple of months, and you're like, yeah, man, things are going to go good. I'm going to be able to quit whatever I'm trying to quit or pay a specific bill or, achieve my goals. And then all of a sudden, the overtrading Grim Reaper comes out, and then all of a sudden everything that you worked hard for the past couple months, maybe even years, has now been completely violated. then how are you going to feel? Right? You're not going to be able to come back the next day with a clear head. You might doubt yourself entirely. A lot of people quit because of stuff like this. And it's totally unnecessary. But again, it's part of just human nature. But we have to work through that. And how do we do that? What's the most dynamic, effective way to do that? Have a long-term vision, okay? And put limits on your trading. Over-trading and over-leveraging will never, and I mean never, be the answer long-term. Maybe short-term if you get lucky sometimes. But it will never be the answer. And professionals don't behave that way. Okay? And over-trading and over-leveraging, again, going back to the equity curve situation, you want it to be a smooth stair step. You don't want to see wild impulses higher and then wild roller coaster rides to the to negative. Because just looking at it, it's an ugly equity curve. And it makes you feel some type of way. And professionals don't have their stuff looking like that. If it looks like that, they get fired. If you're trading for like a firm or whatever, like a bank, whatever the case may be, I highly doubt, for the most part, that people are over trading and over leveraging, having extreme equity curves. If you do feel you got to take more trades because for whatever reason you feel like that's what you want to do, then your risk should be even lower than anyone else's. You should have 0.25% to start with. So that gives you more trades to take, but still only risking a minimal amount, whatever your daily risk allocation is for your own personal trading. If you want to take 5 trades in a day, okay, and you're risking 1%, you got to calculate how much risk each trade should be. That would, then get you to that max risk you're putting on yourself. But again, it's unnecessary. That's not to say too, if you take the 1 to 2 trades approach, like I tell everyone to do, because it's provided evidence. That's not to say that you can't start each day with the lowest amount of risk. Put a trade in just to maybe desensitize yourself and maybe get a feel for what the market's doing at the lowest possible risk possible, just to get a feel for things. And then if it starts going into your direction, maybe you scale in with the other couple entry opportunities you may have. This is professional risk behavior. Because as a trader, I've mentioned it before, your job title as a trader in the profession is not a day trader. They don't say, Johnny is a day trader. No, you're a risk manager. You manage risk. And there's a reason for that, right? Because that's the reality of it. And most people don't see it this way. But then again, that's why most people cannot be traders. This industry is for everyone, but those traders that refuse to listen, that refuse to do things how they need to be done, they end up seeing that this, maybe it isn't for them. And that's okay. But if you're willing to listen and face these harsh realities and make the changes and change as a person and do what you're supposed to do, it's for you. And if you enjoy listening to these types of things, whether it's, stuff that we talk about or things that ICT talks about, and you take or you get excitement from these types of things, then trading is for you. It's just we're not born with discipline. We're not born with all the answers. And some of us have to go through the fire before we make any real change. I know I did. I was taking sometimes 20 to 50 trades a day when I first started trading Forex. It was the dumbest thing I've ever seen. When I look back on it, it's absolutely horrible. I was stressed beyond belief, aside from stuff that was happening in my personal life. Well, now me looking back, I really wish that I would have had someone like me telling me this, because then I would have not been through all the pain that I've been through with trading and, adding on top of everything else I was dealing with. More trades won't get you to your destination faster. More trades opens you up to more risk. And it's that's just the reality. Again, I don't care who says what. Most of the people that are saying that are also selling some type of items that they want you to buy. They want you to stay engaged. The more you trade too, mind you, this could become an addiction because every time you click the button, dopamine pumps out. Same with drugs. You do drugs, dopamine kicks in. That's why people get addicted to gambling because dopamine. So the more trades you take, the more risk you have at opening yourself up not only to more risk, but also, more stress, but it's also putting you at risk of becoming addicted to these bad habits because, just read up on this topic that I'm mentioning here. It's a known fact that this is part of the reality. How do you trade safely? How do you do this in a healthy manner that long-term can potentially provide you with success? You act as a professional. Professionals aren't in here acting like junkies. They take calculated risks and they manage risk, and profits come as a result of trading well, following rules. It doesn't come from over trading, and it for damn sure doesn't come from over leveraging. There's ways to maximize your trades. As you see, there's some traders that do phenomenally well. Copy trading, adding multiple accounts to each other, and then taking one, 0.25% risk in one account, spread that across, that 0.25% risk across, 15, 20 accounts, and there's your multiplier to aim for higher amounts of profits in a safe way for all your accounts. So over trading and over leveraging is not the answer. There's ways to maximize strategically and safely. But if you overtrade and over leverage, you're not going to allow yourself to get to where you're trying to go. Again, this doesn't sell anything. This doesn't sell the dream. This doesn't sell a product. This doesn't sell super positive vibes. Okay. But again, you'd rather me tell you this than someone that, cares versus having the market tell you. Okay. Because the market will gladly destroy you. After all, that's what it's here to do. It's not here for us to win. It's made to manipulate. It's made to siphon money from the impatient and put it in the pockets of the patient and well-informed. That's the whole reason this is even a thing. So knowing that, and then considering some of these things that I've mentioned, I hope it's very clear to you that next time you decide to overtrade, you're basically telling yourself you want to fail. You're basically telling the market, yeah, come and violate me because I cannot stop. I need it right now. And it's very interesting how the more we feel we need to win, we need to make money, the more of that mindset, we take into trading, the harder it seems to achieve. It's the as close as it may feel, doing these types of things puts it right in our reach, but it's just too far still. It feels right there, but then it's just so far away still when these types of things are taking place. All right. So do whatever you have to do to remove this from your trading. Again, I'm spending time with this conversation here or element of trading because I've gotten so many messages the last week or so about over trading, and I almost had, I had $200 to pass my funded account, and I blew my account because I over traded. I was like this close to a payout, my first payout, and I blew the account because I couldn't stop trading. It's not worth behaving that way because that's not what people promote. And if there's somebody on the internet that you hear or has influenced you to think that overtrading and over leveraging is the answer for anything, they are stupid. Okay. It's just simple as that, so yeah, I hope that you guys take what I mentioned right here to heart, because again, it's so important. So important. And it will make or break you as a trader. And you don't want to get broken. You know, you want to stay intact and live to fight another day. And that comes from being disciplined. Long term, also, success in trading comes from being disciplined, having your plan in place, understanding conditions like, you know, what we discuss on a weekly basis, how to identify what the condition is, where price may want to go. But aside from that, risk management is the number one thing. At the end of the day, professional traders are called risk managers for a reason. You know, the title isn't profiteer or profit taker or, you know, anything related, or even day trader. It is risk manager. So you go into your trades, each trading day, each week, saying, I'm a risk manager. I have to do what? Manage risk. Follow the rules. No over trading and over leveraging. And then you ask yourself, why? Why is that something I have to do? Because it will extend things and open your account up to risk. It'll open you up to mental damage, you know, siphon off your mental capital. And then you'll have the beaten dog syndrome, and you'll hesitate. And then you'll hesitate and miss a trade. And then you'll spiral back into the thought of, oh, well, I missed the trade. Well, let me just try to get in. And then, you know, you'll take a loss. And the next thing you know, you'll have 5 trades on because you feel like you missed that first trade out of control and blow your account. And the cycle will repeat because guess what? If you do that long enough, it becomes a habit. So it's best to cut it out right now. If you deal with those issues, cut it out right now. 1 to 2 trades a day. Regressive risk control. And, you know, all right. So, yeah. I hope you guys take what I just mentioned seriously, because it is so important. All right. But, yeah, so, again, looking at what we see here, again, we have that SMT. Let me look at some of the comments. They will never learn properly and grow. Yeah, the impulsive behavior, it's unfortunate. It's heartbreaking, the stories that we hear. Can you guys let me know in the comments if the quality on the video is okay? I'm getting like alerts here that YouTube is not receiving enough information. Yeah, I hope it's a bunch of nonsense. What the hell is being shown to me right now? YouTube is not good on your end. Okay, cool. Yeah, it says YouTube is not receiving enough video for whatever reason. Okay. Yeah, well, YouTube, you better figure it out because pissing me off already. All right, but yeah, so again, we want to see what this is going to do, the yields, right? If it stays below this weekly fair value gap, this other weekly fair value gap here, and the middle point of this wick, and just starts to deliver lower, that's a good sign for us to want to go lower. And then we'll obviously continue to monitor the interest of price wanting to maybe blow out these lows. But if it's to violate that and get above that, use it as support, then obviously our eye goes to these other weekly highs. I mean, you also have the wick here too. You could reuse that. There's a 75% of it. So that could end up being a buy-side target. But again, if that doesn't take place, we're still in a position where price still looks like it could favor sell side. This retracement, bullish, is a result of obviously the SMT, and then price taking out the higher time frame low here, pulling back into the buy-side premium array. Okay, that being the fair value gap, and then you know, some of these inversions, and then large down wicks, and then of course there's SMT at the highs. We'll see if that's going to be supported, and try to once again try to take out the lows, because nothing's changed overall delivery wise. So that's what we're going to continue to think here with that, with the yields impact the DXY. when it comes to the bonds here, we're going to look at the opposing view. We'll see if we'll see if that happens. Obviously, if it gets above here and goes higher, that would support the SMT here, pushing price lower. But again, we're at a level where we got to observe what it's going to do. Nothing has promoted continued downside just yet. It's a result of us basically leaving these lows that were taken. Price retraced. I mean, you can make the argument that we went from high to low, came back to equilibrium, got above it a little bit, hit a premium array. Now price is starting a turnaround here. So again, if we break through the midpoint of this wick, violate the fair value gap here, and turn it into an inversion, and then maybe get below this fair value gap and this volume imbalance / new week opening gap, all of that supports us going lower. Okay, so if that was to be the case, then we can get behind that objective. And then, of course, we have the federal fund rate coming out this week, so that's going to be impactful and will, in my opinion, dictate wherever price is going to want to go, whether it's going to want to purge out these lows or attempt that one more time, which could fairly reasonably be the case. I mean, I could see that taking place. We do have equal highs up here. That's a little far away. I mean, this is also kind of far away too. The SMT here, though, again, we're going to want to monitor and see how that's going to behave, if that's going to be justified. If this does look to start dropping aggressively as a result of the federal fund rate, the indices are not going to be done here with this huge downturn. You know, we may even want to get down into this level if we get the bonds and yields promoting that. So yeah, we're gonna keep that in mind. Let me put on some of the annotations real quick. Again, if you guys get value from the content, definitely don't forget to like the video, share with your friends, and I greatly appreciate the support. But yeah, so those are some of my assumptions here. We got to see if this SMT is going to stay intact, and obviously that will be justified if price was to smash below these lower portions here. Okay, and then close below and use it as resistance. And then again, if that does take place, I wouldn't go against seeing this go higher and doing what I mentioned. But again, we got to just kind of gauge what the response is going to be, and then of course what the result's going to be of the federal fund rate, and then that will more solidly determine what price is going to finish the month doing, in my opinion. All right, if we look at the monthly chart here for the yields, we've had a bullish candle, right? There's a monthly fair value gap here too. That's interesting how the monthly fair value gap lines up with a weekly fair value gap. Oh, wait, no, that's a monthly fair value gap. Whoops. Where is the monthly fair value gap? So yeah, those are kind of my observations. I mean, there's really not much else to identify aside from here. Let's take this, make it full screen real quick. So again, downside, we have this fair value gap. We have an SMT at that fair value gap. Right? If that does hold and price goes higher, then we'll anticipate, price may be wanting to blow out these highs here. And then, of course, the weekly high here would be the first objective. If price does want to go lower, then obviously the weekly low would be the first objective. And then, of course, these would be our supporting ideas if price gets below and uses them as resistance for us to target sell side. And then, of course, if that takes place, our eyes for these markets would jump to here, right? But again, I want to see justification for that to take place. And then, of course, the DXY, or the yields, if the bonds are going to favor sell side, right, say it does come off the high and do that, then we would be interested in seeing the yields going higher, getting above these areas. That would indicate that the currencies would probably look to decline as well. There's an argument to make for that. You also see SMT at those highs too. Okay, we got SMT at the highs there as well, right? So failure swing here. So yeah, if the yields are going to go higher and the bonds are going to provide evidence that they're going to go lower, again, that will dictate this going lower. Okay, and then what's down below us, right? Buy side's been taken, so internal range liquidity, outside of the fact that we've taken the buy side and external range liquidity, that would promote us attacking one of these levels. Fair value gaps, order blocks, lows in an uptrend, all of that is internal range liquidity. So once external is taken, that being highs in a buy side delivery, once those highs are taken, or maybe a premium array is taken, price is a lot of times interested in seeking internal range liquidity. Again, that is fair value gaps, internal, inside of a range, bullish order block in this case, and then swing lows. Those are all internal range liquidity in a bullish trend. All right. So if it is going to reach lower, again, that's supported by us at some point seeing the bonds digging lower and getting below those levels I mentioned. Getting below those levels would confirm the possibility for this SMT holding and more downside getting targeted. And of course, there's a large sell side liquidity pool down here we showed a second ago. And again, if that's going to be the case and it's going to favor sell side, then we see this already being so aggressive to the upside, that would then transition most likely to seeking further sell side targets. All right. And then of course we would be able to get in line with that, justified by the interest rate markets as well. But again, if this holds, right, say we don't attack these levels, right? I called the fair value gap here last week to be attacked, or what was that, the week before? And obviously it did that, right? And last week, as a result of that, and the result of them leaving an SMT there, meaning one did not deliver to the same type of PD array versus the other, right? The fair value gap here was met by the GBP, and the fair value gap down here in the same capacity was not met here with the euro, meaning the euro was the strength holder between these two correlated assets. And then, of course, as a result, price ended up continuing to rage higher. What did it attack? It attacked, I believe this is a wick on the weekly chart. It attacked the wick quadrants, came right up to the midpoint of that, stopped, and started a retracement. So again, highlighting the importance of the wick behavior and how price utilizes them as dynamic support and resistance, or a PD array of some kind, and then of course acting as a target as well in many cases. So the fact that it failed that, there's SMT at the highs, we do have the relative equal highs. We'll see if that's going to want to be utilized. But if the bonds are going to go lower, if we do see evidence of that, again, the interest for price to now seek sell side here and attack internal range liquidity off this buy side run is highly likely. So if we see evidence of that, obviously we'll trade in that direction. But given the fact that overall we're in a buy side delivery, bullish trend, that would be counter trend objectives. So risk again would be cut in half, because that's just the way it is when we counter trend trade. It'd be pretty interesting to see this respond lower from here as well, because we had a conversation last week about counter trend objectives and how to navigate counter trend trading. I also have a video about it on YouTube. If you haven't checked that out, definitely go check that out. But when prices, in this case, right, for this example, moving higher on the higher time frame, when it hits an opposing PD array, like a bearish PD array of some kind, in this case, right, we have an order block. We also have a up wick that acts as a premium array. Price came up into that, so, and then we also have a fractal high here. Okay, all of those elements can justify price turning or giving some type of retracement inside this bullish run. All right. We could see this too, right? Off of this. This was an inversion for value gap. These consecutive up candles was a bearish order block. We also have a wick in here. And then, of course, we have this larger fair value gap here as well. Okay, once it hit those levels, look what happened. Price retraced. What did it do? It also took out buy side. So what did price do? It reached down for internal range liquidity, swept out some internal range liquidity, and then again vaulted higher again, which we were ahead of, right? We were talking about during that week. If you go back and look at the replay if you want. But then price catapulted to the monthly fair value gap. We had all these levels outlined ahead of time, and in stunning fashion, it delivered to and through it, right? So yeah, we'll see if a retracement is in the cards. If not, I would anticipate that the bonds will end up running higher at some point. But again, there's been a huge cracking correlation, so I just want to see when things are going to kick back in line. But again, this is buy side delivery until proven otherwise. What proves us otherwise? 3 PD arrays to the downside being violated in a fast capacity. In this case, we have fair value gap. We have a monthly fair value gap. We have an order block here. Of course, we have the swing low. So order block, fair value gap, swing low. And then, of course, this monthly inversion fair value gap. So if all those levels, if we're going to continue going higher, we should see those levels holding in price. And then eventually, if it does reach down there, continue to go higher. But if they're violated, that starts to adjust our mindset, right? And we have to see price start to impulse back in the bullish direction if we do see those levels taken. It has to have something like this take place in order for us to trust the buy side will continue. Otherwise, price could make a turning point up here, especially because we have the SMT at the highs. So we'll see. Because we've taken the highs here on Euro, and there's an SMT, I wouldn't be surprised if we now kick into some form of a retracement. There's a fractal high here too on this daily chart. Generally, there's rules around the fractal patterns forming. If there's a fractal high that forms on the daily chart, once that third candle forms, creating that 3-bar fractal pattern, right, the lower high here, higher high here, and lower high here, add a higher time frame PD array, or after it's taken a liquidity pool, when those things are in place and you see the fractal high forming or complete, the next 1 or 2 candles can be anticipated to turn around against that, right? And in this case, reach for sell side in some capacity for some form of a retracement. If you go back and do your studies, you see how that took place, right? There's a fractal high here. It takes place all over the place, right? A fractal high formed here. What did it do? The next candle after this third one ended up being a bearish candle, okay? Sometimes it doesn't do it, right? Sometimes it, sometimes it won't do it, and it'll just be too quick, and it won't even present a couple of candles for a retracement. Most of the time it will. So keep that in mind. Fractal highs, when they form at higher time frame PD arrays, can lead to retracements, especially if you meet them at a higher time frame opposing PD array. In this case, a bearish PD array, fractal high forms. So now we can see once that third candle formed, it's reasonable to anticipate price going against, in this case, the overall buy side, so it can retrace in some capacity. So you can start to see how you can now start to piece together, a different narrative inside of, in this case, the bullish trend. You can piece together further counter trend framework. Maybe you can get comfortable with that, or just be able to use it in your analysis. But yeah, it doesn't have to be overly complicated. I hope that wasn't too complicated to understand. But it's a very, very common, effective tactic to frame out when price is going to turn around a bit. So then you can start to aim for things like a bullish order block, or a bullish fair value gap, or a swing low potentially being targeted, and still not let go of your higher time frame narrative. This is an example of how bias can change inside of a narrative. Right? Narrative is the bigger picture. Bias can be retracements or continuations inside of a particular higher time frame narrative. Okay? So yeah, I hope that makes sense. So again, just to recap what I'm looking for here on the currencies, We are at an order block, a fractal high formed. We've now delivered into that discount array. Euro and the GBP have a cracking correlation. One, that being the euro, has taken the high versus the other one, the GBP, that has failed to take the high. They're still relative equal highs. We're still in a buy-side delivery. Okay, bullish narrative. Again, I wouldn't be very surprised if we do look to maybe purge this low out. Depending on how price delivers through that area into this fair value gap, again, that would determine whether, is it going to be something like this, sweep it real quick and then quickly get back above it? Or is it going to impulse lower and really violate these levels, which could then start to lead us to possible adjustment in overall direction if, we continue to see things support downside delivery as a result of that taking place, if it does take place. Now, if it doesn't take place in that way, we're going to continue to favor possible buy side. We just have to wait to see a response away from logical levels like this fair value gap or this bullish order block. Right? We'd have to see price start to push away from that, show interest in getting to the buy side targets, if of course that is what's going to take place. For now, we hold that objective. We hold the assumption that price is still possibly going to continue going higher. Going into this week with a light assumption, knowing that we are in a bullish trend, we wouldn't be surprised if price does look to retrace and maybe come into some of these areas here. Whether you could frame a setup off that or not, obviously depends on whether you're okay with counter trend trading and is that inside the rules that you employ and just your experience trading counter trend ideas. If you don't have experience with it, you need to study until you get comfortable, and just continue to watch these types of videos, breaking this type of perspective down, because eventually you'll get good at either identifying it or identifying it and trading it. Because you could simply use this logic to help you get comfortable with when you should trade. If you're a trend trader only, and if you're in a bullish trend, you only want to take buy side, or if you're in a downtrend, you only want to take sell side. This is a way to gauge when that can possibly present itself. In this case, possibly present a higher move. You frame it at higher time frame PD arrays. And then once you see a response, or if you don't see a response, that gives you some valuable intel in terms of whether, it's going to be a good time to get in line with the trend, or is it going to consolidate or completely turn around and reverse, which of course we can also layer our 3 PDA rule to also justify, as well as intermarket relationships and stuff like that. So similar to how the market maker buy and sell model tactic can be used as a framework or an overall contextual tool to a potential narrative you're trading within, this idea, identifying or being able to utilize a skill set of counter trend ideas and understanding, that can assist you in framing out when the best times are for you to trade. If you only take trends, say you only want to take, like I mentioned, buy side delivery or sell side delivery in those specific trends. This is a tool that can help you get more narrowed into when you should trade, when you shouldn't trade, so on and so forth. Right? It could just be a tool that you can use. Or, like I said, you can possibly get comfortable with trading it. It all depends on your perspective, what you're comfortable with. Right? So, definitely worth the study, obviously. But yeah, that's my assumption for the GBP and the Euro USD. We'll see if this holds and goes higher. If not, these are our invalidation levels down here. And we will march forward with that in mind. We do also want to consider this huge weekly fair value gap. All right, so again, we'd like to see what the response will be from that as well, keeping those levels in mind. All right, so let me just, for completeness sake, put that there. See, again, a retracement would not be unreasonable. Just looking at price here, it's so extended. We have a fair value gap that's formed. So again, I wouldn't be surprised if this turns us into a retracement period But again, if it starts blowing out the bullish order block, blows out this fair value gap, and just slides through these levels in this weekly fair value gap, and we also have this inversion too, along with the monthly fair value gap, all those levels getting violated shows you valuable intel that price has now changed potentially. So then you would start to build a narrative and make the adjustment there. Okay, but again, none of that has happened. So unless it does happen, we hold the objective for price to want to go higher. Starting the week, we think of power 3, like I always mention. And because that's the case, we anticipate that if price is bullish, it's going to most likely look to want to dig lower. Now, there could be a difference here because we've already delivered to a discount array going into the new day or new week. So we want to see how price wants to open. Is it going to respond from here? Or is it going to violate the order block midpoint and then, target the low for this retracement? Because again, you could frame a setup off of that as well. But the assumption, if price is going to stay extremely bullish, I prefer to see us not really spend much time here and then deliver, maybe blow out the highs here. Then whatever happens up here, right? We'll be able to decide whether that's going to give us a strong rejection away from that, or if price is going to run up and maybe even look to seek this, because that's the next level of liquidity up here too. Right, but we'll see. We will see now, won't we? So yeah, I hope all that makes sense. If you have questions about any of the assets we've looked at so far, definitely let me know, and we can go over that. But otherwise, let's go to the DXY. So if we look at this weekly chart, let's jump to the monthly chart too, we could see how the open price of the month is up here. And we've now reached into a monthly fair value gap after purging out all this buy side. We do have a little bit of this fair value gap left open down here. So obviously it's a very long-term view. So if it was to violate through this monthly fair value gap, overall in this monthly time frame, my attention would directly go to this fair value gap, this low, along with this low here. Right? If it's going to hold and it is going to want to go higher, we should be able to get back above or leave the midpoint of this monthly fair value gap open, and then just hit the middle, maybe hit the middle. Preferably not if it's going to go higher. But if it hits the middle of that and then maybe even eventually closes out the rest of this, our eyes would jump to the low here. That's a monthly low. These are all monthly candles. Just so I don't gloss over this as well. I think I mentioned it in the other one, but again, we're on the monthly time frame because when we start the analysis, of course, we go from the news, then we go to the different assets, but every asset we look at, go to the monthly chart, find the monthly high and low. That's your current range you're trading within. Then once you go to the weekly, you find the weekly high and low, current and previous, right? The most near term. And then any other low that's available on those time frames, because those are monthly, weekly, and daily lows. Very important if we're close to them. Like this low doesn't matter at this moment. But you know what does matter? This low. Right? And you know what else mattered? This low. Right? You know what else that's in close proximity? This fair value gap. When we were up here, this fair value gap, this low, and this low were all important. And what did price do? It used all those levels of liquidity. Each of those could have been used to frame a potential idea once price got really close to it. But you wouldn't know these levels are there if you don't identify them and place importance on them. It's not always about the seconds chart, the minutes chart, the 1 hour chart. It's not always about that. Obviously, if you're doing analysis on those time frames, the highs specific to those time frames and lows are important. But of course, we root ourselves on the higher time frame. And if we could paint a picture identifying the interest for price to reach for one of these levels on the higher time frame, when you go down to the lower time frames, things become a lot easier to navigate and easier to frame opportunities around. Okay, So yeah, again, monthly high is here, monthly low. So if price is to want to reach down to these levels eventually, obviously we'll deal with that when the time comes. But if it does want to get down there, or if it does want to trade to this this here, it's going to want to blow out this low. This low, I'm assuming, is a previous week's low. Go to the month, right? Go from here to the weekly chart. This is that low. So yes, it was the previous week's low. So you could see how it transposes from one time frame to the other as well. So this has swept out the low here, hit a monthly fair value gap. So because we hit a higher time frame PD array, going into this next week, we also have a weekly fair value gap that was just created as a result of last week. And then going into this week, it's going to have a fair value gap up there. So the price is going to go lower here if it does choose to do so. When it's going to retrace, right? So if this week's going to be a bearish week, I'd want to see it run up on this weekly chart. Put a wick into here. Maybe it actually ends up in a bullish candle and delivers up into here for the week next week. And then maybe the week after that will end up kicking in line with a downside objective again, right? Regardless, though, when we open up, we have this previous week's high and low, right? It's whether it's gonna do a delivery to this weekly fair value gap and go lower, or if it's just gonna tank and go lower. Before that takes place, the next candle that forms is going to have to violate this previous candle. It's going to open up inside of that previous range. So that shows you why the weekly high and the weekly low are so important. It shows you why the monthly high and low are important. It shows you why the daily candle highs and lows are important and previous days highs and lows. The same logic goes to each of those time frames. And understanding that allows you to identify important near-term liquidity pools that you can use to frame setups on. And because this will always be here, aside from all the other things that we talk about, you'll always have something to frame a setup on. Right? Most people don't think about it this way, But this is a reality, right? It's in the market. It's there. Hopefully you could see that it's there. So every time you get on the chart, first thing you do is look at the monthly high and low, weekly high and low, and daily high and low in the previous couple days, right? In the previous week. And if we're close enough to the previous month's high or low, you identify that as well, because that can be a target as well. And that's before we realize or can see what price is going to overall do. In this case, price has declined pretty aggressively. It's broken multiple PD arrays to the downside. Aggressive as hell. All right, so my idea for DXY possibly changing, right? Overall, if the narrative is going to change from this harsh down delivery, I'm going to have to see a couple of different PD arrays violated to the upside. We have a monthly fair value gap. We have another fair value gap in here that could be used as an inversion. We have this fair value gap, the quadrants in that. And then we have another inversion for value gap up here. Okay, so obviously that's a pretty large distance because it's been so volatile. Okay, but overall, one more thing too. From this low, if you gauge it from this low to that high, you could see where price is at here. Right? In terms of overall range, equilibrium, identification, so on and so forth, premium and discount. We are definitely below the parent time frames equilibrium, right? So price could want to retrace up into these levels. But again, if it violates and gets back above equilibrium here and just starts to destroy these areas, there'd be no reason for us to force sells. In that case, we would just go with where price is going to the upside, right? Because we swept out this higher time frame low here, I wouldn't be surprised if they do look to retrace. Because this is the weekly chart, we're looking for a weekly candle to form, one weekly candle to form on this time frame. Which direction is it more likely to go in? Well, because we've swept out this low down here, I think it's more likely that price is going to want to retrace first. So maybe this next candle for this week, maybe it's going to end up being a bullish DXY week. What does that promote in the indices? Possible continued downside delivery. Right? Those are very easy assumptions to make based on some of the things we've talked about the last couple of weeks. Right? And then kind of narrowing our focus to what liquidity pools are important. Right? Monthly, weekly, daily. And then PD arrays that are in close proximity of those. You know? So yeah, so far, does everything make sense? And again, just another reminder, if you guys get value from the content, definitely like the video, subscribe to the channel if you're not already, and tell your friends if you think they could benefit from these conversations. Again, it's greatly appreciated because obviously it shows YouTube that you guys get value from the videos, and then more people just like you guys will hop on and get this video recommended to them. So it definitely helps me out. I'm doing this for free, right? I'm not charging anybody for anything. So yeah, it's greatly appreciated. But yeah, let me know in the chat if you have any questions about any of this stuff that we've talked about. We've talked about a lot of things as we generally do. But now obviously we're getting to a more solidified assumption as far as what we think this week should show us. All right? So let me know before I move on if all this stuff makes sense so far. Damn, that lag is pretty insane. It's a pretty crazy lag. Yeah, we're getting to it, JD. We're getting to it. Makes sense? All right, cool. I'm glad to hear you say that, Zach. It's been a minute, so I'm glad to hear you say that. You're in my private community, so of course you just let me know if you need any help individually, and I'll be there. All right, so I'm assuming that it makes sense to everybody. Again, if you do have anything that doesn't make sense, just send a response in the chat and we can go back to it. So yeah, given the fact that, there is a possible likelihood of, this run on the low here, a reaction from this monthly fair value gap, because we're at that level, given where we're currently at, we got a monthly high and low, it's, in my opinion, more likely for price to want to retrace. Oh man, the freaking gardeners are here. Of course they want to be here when we're live, right? Hopefully it's not too crazy. But there's more of a chance for this to want to retrace back into these levels. So that's my assumption. We're going to go into the market assuming that that's the case. Last week, we had that same assumption, okay? We had that same assumption that because price was down here, it'd be more likely for them to want to potentially retrace higher before they were going to look to blow this level out, right? And of course, it somewhat took place. It somewhat occurred as a result of the week, but the week just kind of stalled out, right? It makes sense for this to have taken place because of how aggressive this drop was. Okay, this drop was huge. So large ranges lead to small ranges. And then small ranges will lead to large ranges. Okay, many times that's the case. So you could see that as a result from last week as well. So we didn't really do much of a buy-side delivery last week. It kind of just formed another small down candle. But that small down candle's purpose was to blow out the sell side here. So I'm assuming that moving forward into this next week, before any delivery to the sell side continues to occur, if that is the case, I would like and prefer to see price run higher a bit, maybe even present us with a bullish week next week to try to get into some of this buy side as a retracement, and then want to see price maybe continue to drop lower, maybe come and try to contest some more of this downside bullish fair value gap on the monthly chart. Okay, so I'm going into next week if I'm assuming that price is going to want to go lower in some capacity, given the fact that there's been so much imbalance left behind here, it's been so aggressive and there hasn't really been a meaningful retracement that pulled into any fair value gap of any kind up here. I think that's going to be in the cards for this week. So starting with DXY, what am I going to believe? I believe we're going to probably look to want to run higher first. Whether that's going to decide to sell off as a result of that, obviously we'll look to anticipate it because obviously it's still bearish. All right, everything is still digging to the sell side. So, that's what we're going to go into this week, assuming could take place. And again, that could lead to next week being a bullish candle for the week, just to try to get price to retrace into here. But then again, it could just wick up into there and then maybe start its delivery to the downside because we've had that small range. We have a large range and then a small range. One thing you want to realize too is the quarter shift, like we've been talking about. We're changing into the new quarter. That could lead us to harder conditions to gauge. It may also lower the interest in price wanting to do anything important, maybe until some of that volume fully transitions into the new quarter. So again, that's something we're going to keep in mind. Not something we're fearful of, not something that's going to paralyze us, but it's just it's one of those things that you have to be able to gauge. Like, what is the current condition? What are the risks? What's around us that could lack confirmation or make things a little more difficult? That's one of those things that's currently present around us. All right, so that's what we're going to want to see, right? And of course, if this is going to go higher, that would influence the indices and foreign currencies to want to do that retracement I was mentioning on the currencies. But it would send reverberations through the indices as well to want to drop further too, because everything's connected. So everything that we talk about with all these different assets, they influence the other assets. So we can make a determination as far as what, say, the NASDAQ's going to do based on us analyzing these other assets, because everything works together unless it's cracked in correlation, right? And if it's cracked in correlation between the overall assets, that being the interest rate markets, the currencies up into the DXY, if there's cracks all through that, obviously things could be a little bit harder to get full grasps on and trust one way or another. But if this is going to give us a run higher here, say it does look to want to run up higher, we have relative equal highs, we have this fair value gap that it failed to get into, right? If it does want to go higher, that will send the indices lower, and it'll continue to see downside interest. So we're going to start the week with that in mind, okay? So yeah, let me know if you have any questions, but that's my assumption for this. Previous week's low is here. Previous week's high is here. So whether it goes higher into the gap up here, or if it just decides to slide off, it's going to still have to attack previous week's low or previous week's high, one of the two. It may purge previous week's high, give us a wick to start the week, and then look to start its targeting for the weekly low. We'll see if that's, I'd like to see that take place if, in a perfect world, but we could still see price dig deeper into the weekly fair value gap too. So either way, right, we'll go in and have a game plan for either. But we're in an overall downtrend narrative-wise. So any type of buy side is counter trend, so we cut it in half in terms of risk. But if it starts to deliver to the downside, showing support for the sell side to be targeted, that'd be normal risk. We don't trade the DXY, but that's just overall foundation for the assets we do trade. All right, so with that being said, let's take a move on over to the NASDAQ with that background information. With all that background knowledge and background pieces of information, we have a really solid framework and foundation for identifying what this market should end up doing. Okay, so similar to what we did on those other assets, it's the same process, monthly high, monthly low. It's been a bearish month so far. This low here is the previous week's low, okay, but it's also currently the monthly low. So we'll see, we'll keep that in mind. Where are also near-term liquidity or PD arrays aside from, this candle's high and low? We have a low down here, right? Maybe that could be something interesting if it does look to want to still favor downside. If DXY runs higher, again, the target would be this low, right? I would want to see if it has enough juice to get down there. If we do see some type of strong movement, this is the monthly candle. So, I mean, we're going to end the month, at least from what we see here, as a bearish month. So again, I'm going to just continue to favor downside delivery also, because overall the narrative's been bearish, but we can already see that the month has been bearish too. So our sentiment is to the downside unless something changes. But again, we have this low here, we have the high. The high is not important at this moment. This low is, and this large wick here, the quadrants in that, and also this large wick too, the quadrants in that. Those are all important on top of the low, because all those levels are potentially going to be used as targets, regardless of whether price is going to want to go lower and maybe blow this low out, or if it's going to want to run higher. If you take those quadrant levels from this large monthly wick and you drag them over to the different time frames, you'll see responsiveness off those different levels in different capacities. I'll let you go and take that observation in your own studies today when we get off. But yeah, if we look at this market now on this time frame, we can see how again, we just identified the monthly high and low. We now have the previous week's candle, so now we got even closer to price, and now we see the weekly high from the previous week and the weekly low. When the candle opens up for the new week, it's going to be inside the previous week's range. So regardless if it's going to be a bullish week next week or a bearish week, we're still inside the previous week's range. So it's going to have to blow out either the low here if it's going to favor to the downside, or it's going to have to blow out the weekly high first, right? The candle's going to open up starting here for the week. So we got a range above us and a range below us, or portions of the previous week's range above and below us, that we're going to be able to trade within and make assumptions on in terms of targets, right? If it's going to be if it's going to continue to be bearish, I mean, we're so extended over here to the downside. If we're going to be extremely weak still or interested in attacking sell side, close proximity PD array is this wick. So if price opens up here and delivers higher, right, I'd like to see this wick hold, because if it does hold, that supercharges our interest in price wanting to continue to drop and not really have much of a meaningful retracement. There is a chance for us to open up here and want to go higher into this. This is a volume imbalance or a new week opening gap. You can go make that observation as well. Volume imbalances on the higher time frame generally are new week opening gaps on the lower time frames. Just a little thing that we talked about earlier. But again, if we see the DXY decide that it wants to have a strong rally higher, okay, that would again influence this maybe to respect the midpoint of this wick. Maybe it trades up into that to then go lower, right? Again, that'd be power of 3. Maybe if that does take place with DXY going higher, maybe price opens up here on the DXY, sweeps out the low in some capacity, maybe even tries to attack this, and then maybe gives us that response to the buy side for that weekly retracement. And then, of course, that would initiate this to want to retrace higher a bit. Maybe that would respond off this wick here, maybe even this gap up here, and then look to want to favor sell side. Narrative-wise, we are in a bearish trend, so we favor downside delivery. Close range targets is a monthly low, current monthly low, which is this previous week's low. So if it's going to attack any of the other sell side down here, it's going to have to get through that first. It's going to have to get through the quadrants of this wick first as well. But then again, if price is going to want to favor buy side in the form of a retracement in some capacity, we have the wick here, all the quadrants in the wick, those could be used as targets. We have, again, this gap here, and then, of course, this high of this candle to the low of this candle, that's an overall fair value gap, including this volume imbalance we see here as well. We will favor price continuing to want to short until proven otherwise. We're due for some kind of retracement, obviously. It's been 4 consecutive weeks so far of downside delivery. So, I wouldn't be surprised if they do potentially want to give us some kind of retracement. I would just, in that case, also want to see DXY continue to melt off the face of the earth as well. And then maybe, if the bonds decide to rally, that would also obviously influence this to want to give a strong retracement to the buy side. If the bonds look to continue to tank, maybe they violate this low here and aggressively impulse down, maybe that will influence us to continue to short and support the short ideas in the indices as well. All right, so we're going into the week in a nutshell for this, looking to observe DXY's interest to want to either present us with a strong retracement. If that does take place, then obviously this will continue to favor shorts, right? And then targets will be the low of the week, last week, and then the wick. And then if it gets real excited, obviously we have the previous week's lows here as well from these weekly candles. But then obviously, if price does decide to want to collapse here in the DXY, right, we may see this next week look to want to give us a weekly retracement in the indices, possibly. So those are the two different ideas going into this week. This week is going to be when the quarters adjust. So smart money is changing hands from one contract month to the next. Assets are moving into the new month, right? We saw that starting, right? So we see the numbers are starting to, whoops. I don't know what the hell I just clicked on. Yeah, we see the numbers starting to adjust here. Okay, so when the open interest on the June contract outpaces the open interest on the current contract month, which in this case is March, that's when we know that the overall quarter adjustment has transitioned and we're officially in the next quarter, which is the second quarter. Okay, and again, we see that, right? We got to also consider quarterly shifts and overall, different things in place. Because it's the week of that quarterly transfer from one contract month to the next. Again, that is another red flag that could lead us to price not wanting to do much that's meaningful. Maybe it's going to have some type of excitement around the federal fund rate announcement this week. But again, these are just landmines that are sitting in our way. They may make it a little more difficult for you to get a read on things. That's why I'm giving scenarios as far as what the overall direction is. Overall, it's bearish narrative for the indices. But again, there is a possible chance for price to maybe want to give a retracement inside the bearish narrative. And then maybe this week that we're going into may end up being a retracement week, right? We may see that. But then again, if the DXY does choose to give us that same retracement, and price wants to maybe reach higher, that could continue to apply interest to the downside for the indices. And overall, that's within the narrative anyways, right? But again, you want to keep these things in mind. And if price does want to pull back against it, against this downtrend, that's totally reasonable, maybe even to present this new week as a bullish trend or a bullish retracement. Overall, it would just make sense. So don't be swayed from either side. The levels up here, I hope, are easy to understand. If price does start to show evidence for a retracement, maybe DXY chooses to drop, and then that promotes the retracement. Or if DXY wants to fully retrace, because we're coming off this consolidation, we have an argument for a retracement or continued downside, right? So we have those two scenarios. You can't solidify one or the other 100% right now, just because of that simple fact that it makes sense for it to want to retrace to the fair value gap, but it also makes sense if they want to stay weak and just continue to tank and then dig into this monthly fair value gap. And then, of course, it's the same thing for this, right? It's been very aggressive. I'm more interested in seeing this week potentially retrace, whether that retracement is short-lived to then kick back in line with the overall higher time frame narrative, which is bearish. Obviously, we're going to have to wait and gauge, right? We're going to gauge through the week going into this the solid red folder FOMC statements and federal fund rate. Again, like I mentioned, every week, the last couple of weeks, including this call today, we use the economic calendar as a time or as a macro tool, so that we can gauge when things should get exciting or not, right? When there's no news, most likely nothing's going to take place. I wouldn't be surprised if the open interest starts to change, and the June contract month ends up getting more volume into it, more interest into it when Tuesday comes. Maybe, that could end up being part of the impact of this having or aside from the fact that this has no news here, that may be the day that things end up officially going into the second quarter, right? So we want to keep that in mind. So let's pull up some annotations real quick, and we'll get to some questions and then put a ribbon on it. We've had this inversion fair value gap from way over here. You can also make the argument that this one's here too. The reason why I like this inversion fair value gap is because it's also coupled with a run on stops and a delivery that was aggressive away from it. So this became a balanced price range, right? So, just dragging this over, right? Those levels are being utilized, obviously. The midpoint, look how perfect it's being used. Okay, there's a lot of activity that was within that. You could make a similar argument somewhat about this one as well, but we could just use this as a reference here. We also see that there's this order block. The midpoint of that order block is being respected, so we'll see if that's going to, again, initiate the opposing view, a counter trend move. Maybe that initiated the ability for this to want to seek buy side now, right? Price aggressively pushed away. What did it do? It hit a opposing PD array on that higher time frame. What has it done? It's made a wick off of that higher time frame PD array opposed to the downtrend, right? This bullish order block. So is that going to instigate a retracement now, given we have been so bearish? There's an argument to make for that. Is that tradable? Absolutely, in a downtrend. You could trade buy side delivery. This is how you would frame it though, right? To make it, because you don't just go in thinking, oh, it's really bearish, so I'm thinking it's gonna now run higher because overall it's just so extended. That's not what you think. You have to frame things around logical levels, right? This is a logical opposing PD array, and that may justify our assumption that maybe we'll see some type of retracement, maybe even just to come up into this inversion fair value gap, or maybe it's going to reach up into these levels, right? That'd be perfectly logical too. Does that upset the downtrend overall? Absolutely not. Now, if it just starts to blast through that, then okay, there's a conversation we could have about adjusting that too, because we got inversion fair value gaps being violated, we have large wicks being violated, volume imbalance violated, so that we're starting to see multiple PD arrays get broken if it does choose to aggressively want to run and do that type of behavior. If it's going to continue to drop, I'd like to see it stay below these levels. And if it does choose to use this coming week as a retracement time, which would be logical off this bullish order block delivery, right? I would like to see it maybe reach into here and use that as resistance to then start to get back in line with downside delivery, right? But again, like I mentioned earlier, we start the monthly chart, find the monthly high and low, and close proximity liquidity pools like lows or wicks or other PD arrays that are close to it. You go to the weekly, you find the weekly high and low, because now we're zooming in further to the liquidity pools that are important. And you look at PD arrays around us. We look for the wicks, fair value gaps. Again, we have the weekly high and low. We have this large wick. We have this order block that last week has made a response off of. We also have this weekly inversion fair value gap. You could say how the midpoint was being respected. We also now have a volume imbalance or a new week opening gap on the lower time frames. Okay, so price opening up here again, we think of power 3. So if it's going to give a retracement, maybe it digs a little bit lower, but then shows support again, and maybe it doesn't violate the wick midpoint here. I'm assuming that if price opens up and we do drop lower a bit, but then it shows respect to this wick midpoint and then starts to get back above this daily bullish fair value gap, that would be my trigger to assume that this is probably likely to be attacked. And then once price gets up into here, I would have to gauge whether there's a response that's going to be meaningful to get behind the low down here being targeted, or if it's just going to blast through it, because I would go to this wick here, the high here, and then maybe even this upper, deeper fair value gap. Right? So those are the thought processes that would go with either situation. Narrative overall is not wishy-washy. It's not both sides. We're in a downtrend that has a possible likelihood, because we're at an opposing PD array, for price to want to give a retracement within that higher time frame bearish narrative. So bias could potentially be bullish for a short time to get us up into these logical levels. Now, if price does have an interest to do that and doesn't start to deliver, away from stuff, right? Say like this wick here, or this inversion for value gap level. If it just flies through that, then obviously we have that. But if it does respond to these areas as resistance and start to purge out to the downside, we could start to make an argument for the wicks. If price opens and wicks down or trades down into this wick a little bit, can't break through the midpoint and starts to deliver to the buy side, that confirms my interest in this retracement. So I'd be bullish bias-wise up until it gets into that level or proves otherwise. But again, we're in a downtrend. We favor shorts. But for a short time in the beginning of the week, we're going to have to gauge, whether it's going to quickly respond, or maybe a bullish power 3 is going to push us up into this level, or maybe price opens up, pushes up here quickly for power 3 in the start of the week, and then maybe Tuesday or Wednesday, probably Wednesday, ends up delivering price in a continued downside delivery. I'm more on the side, given what we've talked about with the opposing PD array and the large wick we've seen here. I'm more of the opinion that we'll probably see some type of retracement up into this fair value gap. That will be supported by DXY having little to no ability to really contest any of these upper levels. All right, it have to continue to maybe drop a little bit further for the DXY. Maybe it does wick up here and then start to deliver lower. We'll see if that takes place. And if that does take place, obviously we have the previous week's low here for the DXY and the quadrant levels here inside the DXY's monthly fair value gap as well. All right, so to recap, we have the yield market, right? We're going to look and see if price wants to get below this fair value gap. If price does run higher through that, that will support bullish DXY, okay? If it gets above these levels, that supports bullish DXY. If it stays below these levels I have shown here, then obviously we have interest to go lower, and that would be supporting bearish DXY, right? If you go from the high to low here, we're at equilibrium, so it's not unreasonable that they're going back and forth. But that's the assumption for the yields, so you mark that on a piece of paper. And then we also have a similar idea going on with the bonds as well, but opposed to that. We got to see what this area is going to do. If this holds and price goes higher, our attention goes up into here. We do see the failure to get above the midpoint of this wick. We do have that SMT, so there is a possibility for this to maybe want to seek sell side. If this drops and we see the yields go higher and get above these levels, obviously that supports bullish DXY, bearish indices to continue. Okay, so we got to monitor these levels and see how price is going to behave going into this red folder this week, which is going to be very impactful. It has to do with FOMC and it has to do with federal fund rate. So that's going to determine which of these moves is going to be favored, in my opinion, for probably the remainder of the month. All right, and then of course with that in the back end, we got to see how this is going to behave as a result of this order block, right? Off of the possible retracement here, being instigated off the fractal high, forming at this opposing PD array above us, right? It's a wick, right? A weekly wick. So we're going to see, is that going to instigate price digging to this fair value gap? Or is price just going to respond off this and continue to rage higher and then just, kind of leave some of these levels and then aim for more buy-side targets? If it doesn't, and there's a possibility for, or possible interest going into this week, opening up, showing interest to blow out these lows. Obviously, we are going to either frame possible setups to dig down into there, but then once it gets down into here, we're going to have to make a determination. Is it going to give a response higher, in which case that would favor the current narrative, which is buy side delivery, or is it going to slide through that stuff and then overall change things, and start to maybe have interest to dig much, much lower? Again, depending on what happens in the bonds and yields, obviously it's going to have a very strong impact as far as which side is going to be trustworthy or not. If we do see the bonds continue to tank, right? Like say they just completely obliterate these down areas, and then we see the yields rally up, right, and start to smash through those buy side levels, that's going to promote downside in the currencies, supporting this SMT. And then that would also, given the yields, if they're going to be bullish, that would support buy side delivery, okay, into some of this. And then those things behind us would support continued downside within this bearish narrative we're currently trading within on the indices. But again, to start the week, I would like to see if that does end up being the case, right, which is what the current objective is, right? Anything going higher is going to continue going lower because there's nothing that has changed within the narrative, right? We do have a contingency plan that will allow us to adjust and not be married to a bias or narrative. But if things are going to continue with this trend, right, we permit the fact that price could go higher, hit some of these levels, and then start to reject and go lower. Okay, so I'm going to possibly favor price opening up, maybe wicking higher and then going lower if all the stuff that we just talked about stays intact, right? Maybe DXY wants to go higher, give us that retracement into this area. That would promote, again, bearish currencies. If the bonds end up tanking, blasting through these levels, that supports that. And then, of course, I would like to see the yields go higher, which supports bullish DXY, which supports bearish indices and bearish foreign currencies. Right? So, yeah, that is the overview of things. We're going into the week, of course, as always, anticipating power of 3. We're going into the week also understanding that these red folders are going to act as macros. So if we're trying to see some type of delivery on this daily or weekly chart to or from a particular level, we're going to want to see it happen on a red folder day, because the red folders act as macros and institutional sponsorship for those higher time frame moves to take place. It needs institutional sponsorship. It needs it. It is what it is, right? There's no getting around that. All right, so yeah, with that being said, do you guys have any questions about anything that we've talked about today? Does everything make sense as far as what we're going into the market looking for this week? And if you're just looking for overall, indices and DXY, right? We're looking to see if DXY wants to retrace up into this level, maybe create a bullish week, or is it going to retrace a little bit to start the week and drop? Depending on what happens within that. If it goes higher, that supports the downtrend here, right? But if DXY quickly gets higher and then drops aggressively, that may support this going higher. And then we'd have to observe what the bonds and yields are doing and see if they also support whatever it is we see price doing. Overall, we favor downside in the indices because nothing's changed, but we afford the ability to be flexible with the possible retracement, because look at how insane the drop's been, And if we look at all three indices, it seems as though most of them are doing the same thing. We do see a slight SMT here. That may just be used, obviously, for a retracement to continue in some capacity. We have a large wick up here. We also have this large wick before it gets up there. So I'd like to see how price behaves here with this large wick. We have a full closure of this fair value gap here. If you look at the Dow, it obviously failed to get up into there. So as a result, we've seen the continued weakness. But yeah, one thing too to mention, if we look at I already have it labeled. But yeah, so we have this order block here. We want to see what happens. All right, we're in a consolidation. Large ranges lead to small ranges. Small ranges lead to large ranges. So yeah, we'll see if this order block wants to hold. If price does open up for the week, drops down, and then pushes away, that is supportive of giving a retracement. And then, of course, we'd have to gauge what the other assets are doing at the same time. And then, as the week progresses, going into the red folders, we'll see what is taking place. If you guys haven't joined the free Discord, definitely join that. If you're interested in one-on-one mentorship or group mentorship, more live calls 5-6 days a week, more in-depth or personalized learning experience, I do have a private community. You can look into that. You could DM me and I can send you the information. I also have all the information down in the description if you want to check that out as well. But yeah, Tony, no worries, bro. I appreciate you always sticking with me. Obviously, there's a lot of stuff that we cover, and some people will show up to these calls with a specific intention, like I just need bias on one asset, disregarding the entire reason we dig through all these different markets. I could very easily just do one market and just look at that, but that's going to not do you service, right? It's not going to do you justice. It's not going to do you any good because the markets aren't just solely focused on one asset. Everything impacts everything, and you want to know the why, right? You want to know how to trust your analysis, right? You want to know what causes what to take place. There's a lot more to discuss in just one market when it comes to being able to achieve that. And I'm grateful, Tony, that you always hop on. Nutty Fafa, two of my favorite YouTube students. And then, of course, I've had some private community students hop on as well. I got Eddie. I got Zach. All of you guys are amazing. And I appreciate y'all sticking through some of these long-winded conversations. But, yeah, so if you guys don't got any other questions, I guess we'll put a ribbon on it. It's not 3 hours this time. Tried to keep it a little bit more to the point, but still have all the value that I feel is needed. Answer questions and stuff like that. And yeah, so if you guys do have come across any questions or have any concerns or anything, again, just join the free Discord and, we can have a conversation there. Otherwise, I'll see you guys back here on Tuesday for our live trading call of the week. And then again, if you want a more intimate, more personalized learning experience, more live calls and stuff, I do have the private community that you can dig into and get some information about as well. But yeah. Oh, and we got Fritz on the call too, one of my free community students. Amazing. And it's okay. It's okay that you joined a little bit late. Just learning about correlations now. Wow. Okay. Yeah, you're in for a mind-blowing experience with these correlations. And if that's something that interests you and you're open to learning those things, that puts you ahead of a lot of people. Yeah, most people that come to me and see what I talk about with the bonds and yields, most people heard about those, but they just disregarded them. They don't know why they're important. You see, it doesn't matter what the market does, like the specific market. People hear bonds and yields and they ask like, okay, what is that? Tell me more about what that does to the economy, why it's important. None of that matters. What matters is the relationship the bonds and yields have. If the bonds and yields are doing one thing, what does that mean for these other assets? And of course, the yield market, this trio, the 30, 10, and 5-year yield market, if you just learned about it, let me give you the symbols. Maybe you could take a screenshot of these 6. Okay, so there's a 30-year, 10-year, 5-year T-note, and then there's a 30-year, 10-year, 5-year yield market. Okay, the yields specifically impact what the DXY will do, because currencies chase yields, the interest rate market yields. Okay, and so that's why the DXY a lot of times will follow this directly, the 30-year, 10-year, and 5-year, and what that does impacts the DXY. And then opposed to that, the T-bond futures, which is the 30-year bond market, 10-year bond market or T-note, and 5-year bond market / T-note, those three markets are basically positively impacted or positively correlated with also the foreign currencies that are opposed to the DXY, as well as the indices. So if you can figure out what the yields, the bonds and yields are doing, that a lot of times will give you the why behind why the DXY is doing what it's doing, or why it's more favorable to do one thing over another. And then it'll also justify your why behind a bias or narrative with the indices and the currencies, the foreign currencies as well. You couple all those things together and you get a massively strong feel for what the markets are going to do. And why? Why is this bullish PD array? Why does the bullish PD array seem like it's going to be attacked? Why is it more likely that the bullish PD array is going to push price bullish, or vice versa, right? This is one of those heavy impact, heavy hitters on the back end that allows you to have clarity and build trust behind why the market should be bullish or bearish for one of those assets. Vitally important. Takes more work. It's not like one market is what we're observing, but hey, it is what it is. Can we look at them short term? You can, but it's more important to identify what the higher time frame is doing, because that's where bias and narrative is derived, right? You could use them on the lower time frames too. There's that correlation effect. It's not only on the higher time frames, but of course the way that I operate with them, in the moment I'd like to see things agreeing, but overall sentiment-wise, that's what I really want to focus on, because then that tells me what the bigger picture is. I could take that bigger picture and then go down into the lower time frames on a week-to-week, day-to-day basis, and then it's really effective. But yeah, session price action, it's not as effective, but it's still relevant. It's still there, right? So you could still use it with the lower time frame. You don't want to cement entirely on that lower time frame. Oh, the bond market's going higher, so on the seconds chart or minutes chart, and so that means that the indices should automatically be going. They're correlated in that way. Yes, they're not going to be picture perfect. It's not going to be all end all silver bullet type situation. But for the most part, when things are correlated, that shows you're in a healthy environment. And for the most part, if the indices are going to be going higher, whether you're in a session, a week, a day, we want to see those things correlating, because that just further supports the high chances or high probability of the market going in that particular direction. It's one of the first gauges of high probability versus low probability. Are the markets symmetrical in terms of risk on, risk off? AKA the relationship that we talk about every Sunday call every week, right? I look at all these markets because we're doing a risk on, risk off analysis, identifying what every market's doing and how all of that impacts the asset we choose to trade, whether you trade currencies or indices or commodities. It's all relevant. Yeah, NAS and DXY are better for session price action, but again, that doesn't mean you entirely disregard the lower time frame. You don't want to go to the seconds chart or the minutes chart. I mean, you probably want to prefer to stay on the 15-minute, 1 hour if you're going to look in the low time frame capacity when it comes to interest rates. You don't want to be getting lost on the set, because it's already difficult for most to even be on those lower time frames anyway, because they lose focus of what that higher time frame is doing. But in the higher time frame is the parent, right? So you can keep an eye on those time frames, but you should never go below the 15-minute or 1 hour on the interest rate markets unless you're trading them, because you can trade those too, the bond markets. A lot of times they're actually faster than even the NASDAQ. So maybe that's something maybe you'll like that at some point. But yeah, I use them for tools, right? It's a tool. And so yeah, all right, for sure, Fritz. I'm glad that that makes sense to you. Again, if you have any questions, just let me know. Right, you're in the free community, so I got a lot of resources in there related to that topic as well, I believe. So definitely check that stuff out as well. I'm telling you this right now. Look what Tony said. This changed my life and made the game even made him love the game even more. Right, Tony has been doing spectacularly. It's amazing. Some of the testimonials just off the YouTube family, I mean, it's surprising. It's unfortunate, though, that most people don't have patience. Like, they don't want to sit and watch the stuff that really matters because they just want the answer, right? Like, what is the bias? As if that is the main missing piece. It's not. You can blow your account knowing the bias. But the question is, okay, maybe I give you bias, but why can you trust the bias outside of my opinion? That's what I give you guys when I do this stuff. But most people don't see that, right? And unfortunately, it just goes back to what we were talking about earlier. This game is for everybody, but again, it's not for everybody because not everyone's going to want to focus on what they need to focus on. Not everyone's going to change what they got to change. And, they'll be stubborn. But, take advantage of resources. So worth it. And solidify. Yeah. Zach, you've been with me for a while. You took a little break, but I'm hopefully dragging you back into the battle. Damn it. But yeah, it's this is what's important. And of course it's out there on ICT's stuff. It's in his stuff, but he breaks it down in a very complex way, and he's admitted that he does that on purpose because he doesn't want people out here trying to take his stuff and say they didn't learn from him and claim they created it. So he made it a little more difficult, even in his private community content, to piece everything together. He didn't want losers over here trying to steal the fact that he created it. But there's easier ways to break down everything. I learned that fact by me going through all thousands of his videos and having to explain things to myself. And until I could explain stuff to myself in a reasonable way that made sense to me, but still kept the valuable information from his lessons, that's when I knew, like, okay, I know how to do this. And then, of course, I've been teaching and helping students identify these different things as well and learn the concepts. So that's also kind of reinforced my own skill set as well. They say you don't really know something unless you can teach it to a 5-year-old. Well, I taught it to a 17-year-old, and I also taught it to myself. And I've been able to teach and get a lot of different students to master it as well. So I think I'm doing something right. I think I found something proper, right? So yeah. But yeah, you guys are probably tired of hearing me go off on some of these things. And we pretty much got through everything I wanted to discuss here today. But yeah, if you guys need any help, again, definitely don't forget to like the video, subscribe to the channel, and share with any of your friends that you think can benefit from this type of content. If you guys want, obviously, to stay more in touch, aside from just the YouTube lives, you can join the free community. And if you want to get even deeper and be live, 5-6 days a week, feel free to check out what we have to offer in our private community. And, that option is obviously always there for everybody as well, for those who want to take it a couple steps further and have more, even more support. I do my best, obviously, but if you want to have even more support, that's also available as well. All right, so God bless you guys. I appreciate you guys hopping on with me as always. Glad that you guys have been taking value and continue to build on the things that we talk about. And but yeah, with that being said, thanks for your time. And we will be back live here on the YouTube channel on Tuesday of this week. Remember, we are moving into a new quarter, so manage risk appropriately. Follow your risk rules. Never overtrade. Never over leverage. And remember, this is a lifelong skill. So treat it as such. And I'm sure you guys will be fine. And yeah, if you need anything, let me know. But with that being said, until next time, you guys, I will talk to y'all on Tuesday. God bless.